Welcome back to The Explainer. So, if you've ever wanted to truly understand the hidden mechanics of the modern financial world, you are in exactly the right place. Today, we're unpacking Chapter 9 from our source material on the depository system. It's basically the invisible electronic engine that makes modern trading even possible.
Okay, let's dive right into this. When you look at today's financial markets, they're just this sleek, incredibly fast-paced digital reality. But, it wasn't always like this. Not that long ago, actually holding securities meant literally holding physical paper certificates. And let me tell you, that was a massive headache. We're talking severe risks here. Certificates constantly getting lost, torn, stolen, or just misplaced in transit. And if a certificate was somehow forged, you face the absolute nightmare of a quote-unquote bad delivery.
So, how did we fix all of that? Well, here is our agenda for today. We're going to start with the paperless revolution, explore the big benefits for everyone involved, identify the 4 key players, decode some of the jargon, and then finally, see the system in action.
Section 1.
The paperless revolution.
To escape the dark ages of those physical paper shares, the financial system obviously needed a total overhaul. Interestingly enough, the world's first depository was actually set up in Germany way back in 1947. But in India, the true revolution arrived in the year 1996. That was the year the Depository Act was passed, which introduced this highly competitive, multi-depository environment. This fundamentally changed the landscape by introducing what's called a scriptless trading system, which basically just means trading entirely without physical paper scripts.
Section 2. Big benefits for everyone.
Now, to instantly understand how a depository works, we have the ultimate conceptual anchor. All you really have to do is think about your bank. The depository system mirrors the banking system almost perfectly. So, where a bank keeps your money safe, a depository keeps your securities safe. Instead of your funds sitting in an account with a unique number, your electronic shares are held in accounts with unique IDs. In a bank, there's absolutely no physical handling of cash when you wire money, right? Well, similarly, there is no physical handling of paper certificates during allotments or transfers in a depository. It's literally the exact same electronic transfer concept, just applied to securities instead of cash.
This electronic shift created a massive win-win scenario across the board. For you, the investor, it means unmatched safety. There's zero risk of lost paper, and you can even quote-unquote freeze your account to prevent any unexpected activity. It's incredibly secure. And for the issuer companies, they save an absolute fortune on printing and distributing all those certificates for new issues or bonuses. Plus, having a quick, secure digital service like this seamlessly attracts international investment.
Section 3. The 4 key players.
This whole modern financial machine requires a very specific cast of characters to actually function. First up, you have the depository itself, which is the central organization. Second is the depository participant, or DP. Third is the beneficial owner, often abbreviated as BO. And spoiler alert, if you're investing, the BO is you. Fourth is the issuer company, which is the entity actually issuing the shares.
Let's look a little closer at the heavy lifters here. At the very top, we have the depository. In India, there are 2 main depositories registered with SEBI, the National Securities Depository Limited, or NSDL, and the Central Depository Services Limited, or CDSL. They act kind of like the central bank for your securities. They hold them in electronic form and ensure their safekeeping. But here's the catch. You, the investor, cannot actually access them directly. And that is exactly where the depository participant, or DP, comes in. Since you don't interact directly with NSDL or CDSL, you open your DMAT account with a DP instead. The DP is registered under the SEBI Act and essentially acts as the official agent, the vital link between you and the depository. Think of the depository as the central reserve bank and the DP as your local friendly bank branch where you actually go to open your account and conduct your day-to-day business.
Section 4. Decoding the jargon.
Let's quickly translate some of the essential technical vocabulary from the source material so you can navigate this system like an absolute pro. First up is a fantastic financial term, fungibility. Fungibility simply means the state of being interchangeable. To explain this, the source uses a really great example. Think of a piece of land. Land is not fungible. Every single plot is unique, different location, different soil, different view. But a currency note, that is completely fungible. One 100 rupee note is exactly the same in value and utility as any other 100 rupee note. Electronic shares held in a depository are fungible. They have absolutely no distinctive certificate features, which makes them completely interchangeable.
Next up is ISIN, which stands for International Securities Identification Number.
You can think of this as the global passport for a specific security. It's a standard numbering system accepted all over the world, defined by the Global Standards Organization. In India, SEBI assigns the task of issuing ISINs for dematerialized shares to the NDSL, while the Reserve Bank of India handles it for government securities.
If you ever actually look at an ISN, you'll see it is exactly 12 alphanumeric characters long. And this 12-digit code is brilliantly structured into 3 specific parts. First, you get a 2-digit country code prefix. For India, that's IN. Second, there is a basic 9-digit alphanumeric number, and finally, a single check digit at the very end to validate the entire code. It's this foolproof system for global identification, and honestly, it's quite fascinating to see it in action.
Section 5. The system in action.
So we know the players and the vocabulary, but how do securities actually move? Well, we have 2 foundational mechanics to understand. First is dematerialization, or DMAT. This is the easy initial process of converting physical certificates into fungible electronic form using a DMAT request form. Then you have rematerialization, or REMAT, which is a much more complex reverse process to turn those digital shares back into physical paper. But what about new shares, or trading? Well, in an IPO, things are completely effortless. The issuer company simply credits the new electronic shares directly to your DMAT account through your DP. No paper involved at all. And during regular share transfers in the market, buying or selling simply results in an instant electronic debit or credit between accounts, completely eliminating transit delays and all that messy paperwork.
The depository system really is an incredible piece of modern financial architecture. It completely eliminated the massive risks of paper, it slashed costs, and it created a seamlessly integrated global network. But it does leave us with a pretty fascinating final thought. If we transition from vulnerable paper scripts to this lightning-fast electronic system in just a few short decades, what will the very next evolution of trading look like? Thanks for joining me on this explainer, and keep learning.